Regarding Silicon Valley Bank, one narrative is that because of inflation and rising interest rates, the value of their holdings decreased. And when there was a run on the bank, they couldn't pay off the depositors with the depressed value of their holdings. Another narrative is that it was a woke bank that hired and made lending decisions based upon diversity, equity, and inclusion, and loaned money for projects like fighting climate change. They gave a reported over $90 million to Black Lives Matter. So this explanation goes, it's wokeness killed it. Or is there another explanation? And how worried should we be given that Treasury Secretary Yellen recently warned more bank bailouts could be coming? My guest has been called America's accountant and the finance guru. He's got a book called Positive Financial Karma. Please welcome Dan Geltrude. Dan, are we in trouble? Should we be worried?
Well, I would tell you this, Larry. We should certainly be concerned. I don't think we should be at the point of worrying and certainly not panicking. And the reason I say that is because I do believe, although there are more banks out there that probably have problems beyond the banks that we know of, I don't think it's systemic. I don't think we're talking about a situation like 2008. But is it serious? Absolutely. And we have to scratch our heads a little bit on this, Larry, and I'll tell you why. Is banking is highly regulated. They have internal auditors, they have external auditors, you have federal regulators, you have state regulators, all looking at each of these banks, and they weren't able to come to a conclusion that there was real risk here, interest rate risk. You do a stress test, that's what it's called, and you look at how much or how a bank could withstand a sudden increase in interest rates. Didn't they do that? That's the question I have at this point.
And Dan, every bank had to deal with an increase in interest rates. Every bank had to deal with inflation, but only some, at least so far, have collapsed. What's your analysis of what caused Silicon Valley Bank to go down?
I think what we have here is a bank that was probably mismanaged to some extent, for sure, because remember what they did. They went out and they took their funds and they put it in long-term treasuries, which locked in the interest rate. Those interest rates were low. Then what happens is the Fed raising interest rates now with the deposits they have to pay out. They simply, one, didn't have enough cash available. That's problem one. And number two is it put so much financial stress on the bank. They said, wait a minute, we're in trouble here. We may not even be solvent. And that's how that played out. That issue certainly could be pointed at this bank being mismanaged or certain banks being mismanaged as opposed to the entire system, Larry.
Dan, what is your take on Biden saying no matter how much money you had in, even if it exceeds the FDIC guaranteed limit of $250,000, we're gonna bail you out. We got your back. What's your reaction to that?
Well, I will tell you this, and it may not be a popular view. In the short term, in the moment when that decision had to be made, which was basically over a weekend, I think they made the right decision to be able to back up those deposits. Because if they didn't, Larry, there was a potential for a real snowball impact where you could have a run on the banks nationally, and we cannot afford to have that. Plus, there were a lot of people that were going to be getting paid after that weekend. If those deposits were not covered, people would have lost their pay. So I think in the short term, it was the right thing. Now, when we go past that, is this a policy that we should have in place all the time? Well, that's the real question.
And the argument, of course, against what you just now said is the moral hazard argument. You just now mentioned this bank was mismanaged. What is the incentive to manage a bank properly if when they screw up, the feds are going to come in and bail out all their depositors?
Well, you're right in saying there has to be consequences because, like we're seeing around the country with crime, if there are no consequences for people's actions, then there's nothing to stop them from doing the wrong thing. So as that pertains to banks, if they're managing a bank and they're saying, listen, we can take risks, unnecessary risks perhaps, knowing that we're going to get bailed out. Well, that's a problem. So there has to be consequences. And I'm going to really be a little harsh here. If banks are mismanaged in that way, intentionally mismanaged, then some people got to go to jail, Larry.
Got a question for you. Are you concerned with stock market volatility?
Markets closing in on their worst year since the financial crisis.
Since 2020, the Dow closed down more than 1,100 points.
Financial markets had their worst day since the start of the pandemic.
Do you really trust this economy?
The U.S. economy could be headed for a recession.
Tonight, the alarming spike in inflation soaring to its highest level in nearly 40 years.
What if you can invest in a portfolio with a high fixed rate of return that's not correlated to the stock market? Well, you can turn your monthly income on or off, compound it, whatever you choose, and get this, there is no loss of principal if you need your money back, and absolutely no fees. Just log on to investyrefy.com. Folks, I personally invest with my own money with YRefy. So log on to investyrefy.com or call 888-YRefy24. That's 888-YRefy24. Dan, Janet Yellen has said there may be some more banks. She didn't give a number, but I've read as many as 200 banks that might be in trouble. Let's take that high number 200. Assuming it's that number, again, does that mean we've got systemic problems?
If the number is that high, Larry, yeah, then I think we have to look at this and say, all right, we have some systemic issues. Not only that, let's take a look at what type of pressure that could put on the federal government. So in all the banks across the United States, you have approximately $18 trillion on deposit. In the Federal Insurance Fund, which is the money that all the banks pay into to self-insure, if there's a problem with deposits that we could pay out, that's only $125 billion. So you could see this gap is huge. So if we end up with a serious systemic problem, then we have a problem in the entire financial structure of our country. We can't afford that.
Let's talk a little bit about inflation. It's gone down from 9% now to 6%, still historically high. Where does inflation go?
I don't see inflation moving one way or the other too quickly. I think inflation is somewhat controlled right now. But the question here is when can we get back to the Fed's target of 2%? We're 3 times higher than that. And if you're only going to be raising interest rates a quarter point, half a point, whatever, in order to get inflation under control and down to 2%, it's going to be like 50 years. So I think the Fed has been kind of death by 1,000 cuts, raising a little bit, raising a little bit. Either they have to be all in, like Paul Volcker back in the early 80s, or hands off and let the natural process, let the market wash this out.
Last thing, cryptocurrency, Dan. The collapse of FTX. Did that affect our banking system?
Well, I think it's having certainly some impact because when you look at a bank like Signature, in New York, Signature was heavily into crypto and got themselves in trouble. Listen, to me, crypto is something that you look at like going to the casino. It's just playing with money. You don't mind if you lose. This is not something that our banking system should be playing around with. This is a high-risk investment for those people who like high-risk investments. But, that to me is not a flight to safety, and it's not anything that our financial institutions should really be involved with.
So, Dan, bottom line, the bigger banks, the Chases, the Bank of Americas, the Wells Fargos, there aren't any concerns. We shouldn't be worried about them.
Well, it doesn't seem that way. And remember this, back in 2008, the Fed was very specific in picking winners and losers. They said, all right, all you big banks, you're going to survive and you're going to have to carry the weight of everybody else. And we're somewhat seeing that right now, right? Because you're seeing the bigger banks starting to buy up the smaller banks. So let's hope at least the big banks are in good shape, and I think they are.
America's accountant, financial guru, Dan Geltrude. Dan, thank you so much for your time. God bless.
Thank you.
Now, I know you love the show, and if you do, show your love. Hit that like button, hit that subscribe button, and then scroll down and join our mailing list. Why, you ask? Well, believe it or not, from time to time, YouTube seems to have some issues with some of our vids. I don't know why. Maybe they're a little too hard-hitting. To make sure we continue giving you hard-hitting, candid programming, be sure to get on that mailing list and also throw something in the tip jar. Make sure the shows keep coming. Show your love. Throw something in the tip jar. 2-drink minimum. And also Larry with Epoch.com, Larry with EPOCH.com. I am Larry Elder. This has been the Larry Elder Show for Epoch Times. Remember, we've got a country to save. I'll see you next time.